You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views. We are, of course, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-exciting, ever-expanding Options Insider Radio Network. If you haven't had a chance to check out our latest editions, listeners, I encourage you, run, don't walk, over to wherever you stream this fine program or download it. And, of course, check out Trading Tech Talk. I know a lot of you out there are really up in arms about Flash Boys. What does it mean for you? What does it mean for the markets? Well, that show dives into all of that in great detail. HFT, how it impacts the derivatives markets, and all that fun stuff. Trading Tech Talk. Check it out. I think you're going to like it. And if you're on the more basic end of the option spectrum, don't worry, we have a new program for you as well. It's called Options Playbook. It breaks down all those fun option strategies into some interesting sports metaphors, offense and defense and that kind of thing. So if you're interested in some options breakdown, some options plays, then check it out, Options Playbook Radio. I think you're going to like it. And while you're checking all of that out, make sure you download our brand spanking new mobile app. It is available for Android, iOS, and even the Amazon platform. So no matter what type of device you're using, we have a version for you. You can, of course, instantly stream all of your favorite episodes of Volatility Views, well over 100 now of this show. It's been going for quite a while. You can also download them for offline listening. Maybe you want to listen to them on the subway or on the plane or wherever you're heading and want to listen to this show, we can do that. And of course, if you're listening to a show and you have a question or a comment about something we brought up on the show or something we said on the show, hit that feedback button right there. It's very easy to send your comments and your questions directly to the hosts of your favorite program. So check it out, the Options Insider Radio Network mobile app. I think you're going to like it. All right, and joining me, as usual, is my co-host here on Volatility Views, my partner in crime, Mr. Jared Woodard, formerly of Condor Options and Klineman Financial Group. I say formerly because, Jared, you've had a bit of a life change over there. Why don't you walk our listeners through what your new gig entails and what you're working on?
Oh, yeah, thanks, Mark. So I've accepted a position in equity derivatives strategy and analysis at BGC in New York. So I'm going to be doing a lot of new strategy work, helping clients. And I'm really excited about the opportunity. It's a really, really interesting role, and I think there's a lot of possibilities for what our team's going to be able to do. It's a little bit bittersweet in that I'm suspending the work I've been doing lately at Condor Options and at Klineman, but hopefully we're going to be able to build on, some of the work that I started there and bring along some clients and people who've liked the work that I've done so far. So I'm really excited about it, and that's good enough for now, I think.
Does this mean you're leaving the paradise that is rural Virginia?
Not just yet. I couldn't resist the summer here, and but I'm going to be going back to New York in the fall.
All right. Glad to hear it. Glad to hear some exciting stuff going on in your neck of the woods. Speaking of exciting stuff, Jared, I know you're pretty excited, as am I, because we have a great guest waiting in the wings. So without further ado, let's get right to it and dive right on into our Volatility Viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, listeners, as the man said, this is, of course, our Volatility Viewpoint segment. This is where we welcome on guests from throughout the world of volatility trading and analysis and research and proceed to pick their brains for the benefit of you out there, the listener. And today's guest is an old friend of the show, even though he hasn't been on in quite a while, so we're very pleased to welcome him back. He is Euan Sinclair, the risk manager over there at Bluefin Trading. Euan, welcome back to the program.
Oh, it's good to talk to you guys again.
Now, Euan, like I said, it has been quite some time, an embarrassingly long time, quite frankly, since we've had you back on the program. So in that interim, we've added a lot of new listeners, and you're sure working on a lot of interesting new things. So why don't you go ahead and give our listeners a bit of an overview of your background in the space and what it is you guys actually do over there at Bluefin Trading?
Well, I started off in physics. I did a PhD in physics, theoretical physics, and then moved on to option trading from there. Started with a small market-making firm and have sort of gradually sort of slid into more of a risk management role from there. So my background is very much in options and volatility, and largely the thing I look at all day is really the VIX, because if the VIX is moving, it sort of tells me a lot about the state of the world. We are a proprietary trading firm. We trade largely option strategies, mainly as market makers. But market making these days tends to involve taking more of a view as well. And we do ETF ARBs as well and commodity options.
Now, it's not often that I could say we have a guest on the show who actually wrote the book on volatility trading, but you can claim that pride of place. You've written 3 books, including the most recent called, quite literally, Volatility Trading. So you have indeed written the book on volatility trading. For those of our listeners out there who aren't familiar with the title, who are you aiming the book at, and what are some of the breakdowns you make of volatility trading in that title?
The original book, which is also the last one, because I did a second edition, which was about twice as long as the original, was sort of aimed at professional options traders. And professional options traders trade options, but then immediately hedge them. So you've really only got the volatility component left as a major risk source. And I think the last really great options trading book was probably written in the early 1990s. So I essentially tried to put down all the rules of thumbs and tricks and stuff that I'd learned from other people and sort of update the sort of, if you want, manual for professional traders. Little in the book was, I would claim, to be original, maybe 10% of it. But I don't see that as a weakness. I see that as sort of, I'm proud to be sort of mining the accumulated wisdom of a lot of traders that I've worked with.
I've said many times on the show, I'd be curious if you agree with this as well, that professionals tend to focus more on Vega and the retail masses out there tend to focus a lot more on Delta. They're much more directionally oriented. Would you agree with that as well? And is that one of the purposes of your book? You mentioned it's for the professional crowd, but also perhaps introduce some of the high-end retail to the more volatility-centric approach that professional options traders use.
Yeah, I think that's a fair characterization. Both of what I was trying to do and what retail traders are trying to do. It's very difficult to trade volatility as a pure retail trader because you have to hedge too often and you'll just rack up an enormous amount of transaction costs, which are one of the biggest killers there is. People don't tend to realize about transaction costs. Everyone's aware of, if you're short options, you can blow up. And that's sort of like being killed by a crocodile or a shark. It's very dramatic. But I'd say transaction costs is much more like catching malaria off a mosquito. You don't tend to realize mosquitoes have killed more people than any other animal on Earth. But transaction costs are really the silent killer. They'll get everyone.
It's interesting, Jared, you should mention that, and talking about these types of directional strategies. In fact, the last time I saw you actually was down at the Risk Management Conference about a little over a month ago or so now. It seems like it was sooner than that, but it was actually a little while ago. And you were on a panel, ironically, titled Directional Option Strategy, which was interesting to see you on that panel as opposed to a more volatility-centric type panel. But I think you made a couple of the quotes of the conference, if you will. I think the first one that really caught my eye, and in fact, I liked it so much I tweeted it out and we posted it on our site. You wrote that covered calls are fascinating because they are one of the few examples of a popular retail strategy that actually works. And I thought that was great because it is entirely true, and B, it is such a simplistic thing, and yet you're right, it does work. And it is a fantastic strategy for a lot of our retail-oriented listeners, as well as a growing audience of the advisors out there. So I could take it from that quote then that you're a pretty big fan of the covered call strategy.
Well, I am. I think they got a terrible reputation for a long time because I think people were attacking them from the wrong point of view. The idea that a covered call is just synthetic to a short put. So all you're really doing is doing twice the number of trades, so you're racking up transaction costs. But it's not really true because people tend to write covered calls because they already own the stock. So you've got to always keep in mind the reason you got into a position, and it's very rare that you'll go into a position purely from a clean sheet of paper perspective. And the covered call as well, it's not a directional strategy. It looks like it is, but it really isn't. It's really just a matter of it's a volatility strategy. The reason you make money is because you're selling an option, and options, generally speaking, tend to be overpriced because they provide insurance, so you tend to pay for that. So if you sell them, you're collecting a small premium. And I mean, I just think that it's a strategy that has a solid theoretical basis that makes sense. It's been tested and shown to work in the past. It's relatively accessible and cheap to execute for a retail trader. If I was starting in options, that's absolutely where I'd start. And you can make the same argument as well for cash-secured puts.
Yes, of course. The synthetic equivalent, the dark side of the covered call, if you will. One other quote that jumped out at me from RMC when you were down there on that session, and again, addressing another very popular strategy, particularly out there with retail. You were definitely on the retail tip down at RMC, Euan. You said, ratio spreads are one of the biggest sucker bets in the market. You can think a stock is going to move, be right, and still lose. I think this is a great quote, too, because we do see that a lot with our active retail. They start to discover the magic of spreads, and they start to discover the magic of ratios. They say, wait a minute, I can put on this vertical or whatever the case may be for an actual credit, and then all of a sudden you see the ratios start to get outside of all rational sense or logic, and it goes from 1/2 to 1/5 and 1/8. And if I can collect a dime for this, why not collect $1? And so I tend to agree with you on those as well, that ratio spreads are an interesting tool, but they're quite possibly frequently misused by the retail masses out there.
Well, yeah, I think this is one of the great dangers of options. You can do almost anything with options, but that doesn't necessarily mean you should. And it's very easy to overthink your situation and sort of go from a fairly simplistic sort of viewpoint, like, I'm going to buy a put because I think the stock's going down, to, well, I don't think it's going down that much, so I'll buy a put spread. Ooh, but like you say, now if I sell two, then I can do a ratio and I can actually collect money and still be right. Well, but you've now taken a fairly simple forecast and put it into a situation where it really isn't the primary decider of whether you're going to make money or not. You've turned a directional bet into a volatility bet. One of my favorite quotes, it's a sports quote from one of the defenders of Liverpool back when they were good in the early 80s, and this guy's an all-time great defender called Alan Hansen, and he went on to be a TV pundit. And he was looking at a young player on TV, and he said, you know what? This kid was doing perfectly well until he thought he was a good player. And I think that's what can happen with options as well. You can take something and do well, but then you just start to think you're better than you are, and you end up in all sorts of trouble.
Yeah, I mean, I want to jump in. I really appreciate the sort of thrust of the comments you're making so far. I think that a lot of listeners who are going to be familiar with your books and the work that you've done might assume advice in a line more towards complexity. So emphasizing these sort of simple approaches, I think really really helpful. To go back to the point you made earlier about delta hedging, I have to say that's one of the most frequent questions that I ever get from clients and people that I work with is, what's the best method, the best regime for delta hedging a position if I want to trade vol. And so in light of this kind of emphasis on avoiding, too many transaction costs, avoiding too much complexity, what would you suggest for maybe not a new trader, but a sophisticated trader who wants to take a view on vol, is confronted with all these different approaches to hedging in the literature? What's the simplicity approach?
Ooh, have you got a whiteboard in a day? There's a lot's been written about optimal hedging, and I mean, I would say at this point, Google is your friend. The classic example that everything came from was a paper by Hodges and Neuberger, and I think that was in 1987. And they basically extended the Black-Scholes model to include transaction costs. So instead of replicating an option where there's no transaction costs at all, you replicate the option, but there are transaction costs in your hedges. And that gives you a certain, not a single option value, but a band of option values. And everything's sort of come from that. And it will tell you that when your delta gets outside a certain level, that's where you should hedge. But that's sort of the mathematics. If you want to take it to the sort of simple financial point, everything you're doing as a hedge is removing risk at the expense of a cost. And the cost is the transaction cost you're incurring. So I think just having that in mind will take you from being sort of a naive trader into sort of the next level, if you will. Those costs seem almost invisible on a daily basis, but really the benefit you gain from hedging is often not as great as the cost it takes you to do it, because each individual cost looks very small, but over the lifetime of an option, it really adds up.
Right. Just to follow up on that, then, so two approaches that I've seen that people seem to respond well to are delta hedging with a view toward an overall regime in volatility, in a kind of a very broad view of what the market volatility is like, kind of adjusting the flexibility or the sort of passivity of your delta hedging approach with that kind of global macro view. Second approach was a little more technical, which kind of focuses more on the change in your position gamma overall over time as a way of kind of stepping away from delta hedging too frequently. And I wonder if you have any comments on either of those.
Yeah, I'm definitely in the second school. I think a good hedging strategy has to take the gamma into account. If you're long a lot of gamma and the market moves, you get taken out of your bad delta anyway, because if you're long gamma and the market moves up, you become long delta. So if you're long a lot of gamma, you have to, because you're paying a lot of theta, but also should hedge less frequently. So I'm definitely in the latter view. But again, this is really only sensible if you're a professional and you have very low transaction costs. If you're anything other than a market maker with direct market access and very low transaction costs that you get from being a member of the exchanges, I think it makes far more sense to hedge on very wide points of view and do a lot more static hedging rather than dynamically trying to replicate.
That's a difficulty we often encounter here on the network, Euan, is that we try, particularly in some of our more basic retail-oriented type programming, to introduce the proper in quotes, I should say, but the proper professional type strategies that most market makers and risk managers and professional traders take when using options. Things like you mentioned, of course, trading delta neutral and being able to hedge your gamma on regular intervals and things like that. But that, as you mentioned, is pretty much out of the reach of all but a very small minority of retail traders out there who have the capital and the transaction costs that make them possible to even take that approach. So it is difficult for us to discuss that with them, and that's also why so many of them have gravitated into more of the volatility-oriented products, because it is, for many of them, a back door into the vol space that's a heck of a lot easier to buy a VIX call than it is to go out and set up an SPX or an SPY straddle and dynamically hedge the gamma and things like that. So again, you mentioned earlier the show that you pretty much spend your days watching the VIX. That's one of the reasons why we wanted to have you on this program. Of course, there's been quite a lapse since the last time you've been on, so we have quite an interim to discuss. But we'll fast forward it to what we've been seeing in the volatility space this year, just in 2014. Of course, it's been a very active year from a volatility standpoint. Just in the past few months, we of course had the Ukrainian crisis and everything else really injecting some vol earlier in the year. That vol starting to come off now. We've seen massive variations and fluctuations in the VIX futures term structure out there. So there's a lot that really has caught our eye over the past few months. I'd be curious what's really caught your eye so far this year in 2014 in terms of VIX options activity, VIX futures, implied volatility, and all just general volatility action in the marketplace.
Well, I think there's this meme doing the rounds right now that volatility is very low, and I'm not really sure that's correct on any level. Like the VIX right now is about 13.5, which certainly seems low. It's certainly towards the lower end of its range. I think the overall average value of the VIX since inception is something like 18.5. So we're certainly below that. But you have to also remember the VIX is very skewed, and the VIX will spend a lot more of its time below its average than it does above it. Because, you know, the VIX can go to 80, but it's not going to stay there, whereas we can certainly stay below 14 for a long time. So I think on an absolute basis, the VIX, while it's low, could certainly stay at these levels for years. Just because it's low doesn't mean it's going to go up. It seems also that every asset right now has low volatility, like currencies, gold, oil, bonds. It's a very low overall environment. So it's not obvious to me that the volatility is mispriced relative to other assets. And if you're trying to carry it by being long S&P vol, that's not really going to work right now either. So both on an absolute and a relative scale, I'm not sure volatility really is low. So I think that general meme has just been widely overplayed. I've been asked to be on a few panels recently about discussing how low volatility is, and I just think that whole premise is incorrect.
But yes, you're right, Euan. That has been there has been quite a drumbeat in the mass media of late around that. You know, we get calls like from different outlets all the time here about why is volatility so low. People have been tossing around for a while now this long-term average of the VIX is actually closer to 20. You're right. That seems to be skewed by some of the 80-plus days we've seen over the past few years. I'm an old-school SPX guy myself, so I tend to fall more into your camp, Euan. I remember when SPX in the mid-teens was crazy high, and you had to sell it. So the notion that VIX in 13 is somehow not fairly priced, but indeed very, very low, I find that somewhat odd as well. A couple other developments we've seen, of course, in the VIX space since the last time you were on is, of course, the launch of a new VIX product. That's always a big deal. And in the last few weeks, we saw the launch of VXST options. These are, of course, the short-term VIX options trying to capitalize on the wave of interest and excitement in weeklies these days, creating their own version of a VIX weekly. It's still very early days, but Euan, I'm curious on your take on this product. Are you interested in them, and do you find yourself using them over there at Bluefin, or are you still playing the wait-and-see game until they get a little bit more volume?
Yeah, I think it's the wait-and-see thing. It's a bit of a chicken-and-egg situation because I think all the market makers are saying the same thing. It's like, oh, we'll get involved when there's more volume. But there's never going to be more volume, of course, until we get involved. So, I mean, that will eventually... It will eventually grow. I don't see why it wouldn't. We don't have the bandwidth issues we used to have, so it's easier to list a lot of stuff now. But we haven't really dived into that stuff yet.
That's actually a good point you bring up there. It's kind of an issue we've seen a lot with new products. We saw it with the mini options last year as well. A lot of firms like yours have been a little hesitant to dive in and provide liquidity in these. Is that just because you find yourself resource restricted in this environment and you're a little bit more cautious as a result? Or why is it you think that so many liquidity providing and market making and even directional trading firms are definitely playing the wait and see game a lot more in recent years than they have been, let's say, in recent decades?
I think honestly the end users have become a little bit spoiled when it comes to bid-ask spread. And, we just wouldn't get paid the bid-ask spread we would need in order, because of the illiquidity in the product. People would expect the options to be, 5 cents wide or whatever. And for us, if it's a liquid and we're not going to get two-sided market flow, it's just not worth doing. So you'll get a whole lot of situations where we'll make a market 20 cents wide and the customer will come in the middle. It's like, we're not going to fill you in the middle in a liquid product. What's in it for us?
Yeah, that seems to be a popular refrain these days. Again, going back to the SEC's interesting, some might say short-sighted attempt to force pennies on the options market when it seems like the natural liquidity in a lot of these products is actually a nickel, or in some cases even wider, where the actual market makers can actually make a living. So again, another firm coming out and saying that perhaps that wasn't the best of choices over the course. That gets more into our market structure type shows and our tech shows, so perhaps we'll leave it there. But there are a lot of other interesting products going on out there in the volatility space, the VIX realm, the volatility realm, of course, the hot realm, it seems like these days. Every time you post an article or do a show, anything related to VIX, Euan, it just clicks off the charts. The listeners, the readers can't get enough of it. A lot of them these days are also migrating, particularly on the retail side, into this massive universe of VIX ETPs. And certainly since the last time you've been on the show, that universe has just exploded. We see a myriad of new products, seems like almost every day, taking on some aspect of the VIX product. It could be a ratio, it could be leveraged, it could be whatever the case may be. A lot of people still flocking into VXX, XIV, and some of them even into TVIX. I'm curious in general what your take is on the massive universe of ETPs, whether it's been a good thing for retail or perhaps a bad thing, perhaps moving them into products like VXX where they don't really understand the term structure and how that impacts them. And then secondly, or following up on that also, would be a lot of people tend to debate whether this universe of VIX ETPs, because it's become so vast now, whether it's starting to wag the dog and starting to move VIX in ways that perhaps aren't necessarily conducive to what's going on with the implied vol of the SPX. So 2 questions on the VIX ETP universe. Take them however you will, Euan.
Well, if I could start with the second one, I think that's probably true, and it's happened a number of times when we've had big moves, particularly with the leveraged inverse ETFs. But I don't necessarily see that as a bad thing. I don't think it's in any way market manipulation. I think it's just another way that markets change and adapt. And if you're a trader, that's sort of what you're supposed to do. You're sort of supposed to get out in front of that and adapt to it. So I don't really have much patience for traders who complain about that sort of stuff, that, oh, this is ridiculous, the tail's wagging the dog. It's like with high-frequency trading. If you take any possible criminal elements out of it, if the tail is wagging the dog, stop complaining about it. Get with it. That's the new reality. Traders we're meant to be pragmatic. We're meant to adapt. We're not meant to say how the world should be. We're meant to trade it how it is. With regard to how many of these products, it should be good for a firm like ours because we can trade spreads, relative value trade amongst them. However, I think generally almost all of the volume is concentrated in a few of the products. So a lot of them aren't even really worth looking at. For example, there have been some overseas volatility indices listed recently, like Eurex has listed the V stocks, but it really doesn't have enough volume to do anything with. If you look at just close-to-close spreads, it looks like there's a trade there, but you just can't really do anything. It's like the VIX before 2006. There just was nothing there. It was listed, but it was trading hundreds a day. So who cares? So I think a lot of the ETFs are sort of in that space as well.
So following up on that, I wonder what you think about the prospects are, Euan, for new volatility products on the future side. I mean, we have this working theory that if you introduce an ETP that attracts individual and other audiences, customers, that you can build up a constituency among the market makers that would drive volume back to a volatility futures product or something like that. I feel like that story makes a little bit of sense for the development of VIX, but I wonder if you would expect that to play out, knowing what you know from being a market maker, for the development of products in the future.
I think that I sort of agree with what you're saying and where it comes from. If you look at the way, like, for example, listing the spiders, eventually spider options drive volume back to the big S&P options, because that's where the pros can do the big size. I think part of the problem with this whole listing of products is that, from what I've seen, and I could be wrong, exchanges tend to list stuff because they can. And so they see, well, VXX is working well, so we'll list a slightly longer dated one called VXZ. But people don't really have any interest in VXZ. They never really did. Just because you can list it doesn't mean it was something that anyone actually wanted. So that's not the way a company like Coca-Cola works. Coca-Cola goes out and actually finds out what customers want, and then they list, vanilla Coke or cherry Coke or whatever. Whereas the exchanges don't tend to operate like that. I mean, I can think of a number of ETPs or ETFs or futures that I'd like to see. Like, I'd like to see, a volatility arb index. I'd like to see, a real cash secured put ETF, or a covered call ETF, and not just an index, but an actual tradable product, or even like relative value traded products, like, a value minus growth ETF. I mean, I think there are lots of things that could be listed, but people don't seem to go about it from the customer-centric direction first.
Yeah, that's an interesting point. And Jared, your point is interesting as well. Of course, the fixation right now on the ETPs as being a primary source of volume, a primary driver of volume. We're seeing that right now with our friends over there at Russell. One of their primary strategies for generating more interest in RVX is, of course, getting the ETP universe interested in it. And that, of course, at least the plan is, that will feed back volume into the main product. So that is definitely, if you're launching a new product these days, particularly in the volatility space, and you don't have some sort of ETP business plan or business model or pitch in place, then you're behind the times. I think everyone has pretty much come around to that viewpoint, rightly or wrongfully, depending on how you see it, that ETPs are the primary drivers, and that VIX itself didn't take off until the ETPs got involved. Again, you could perhaps take opposition to that view, but it is the prevailing view right now, at least in the exchange side of the fence. I want to jump back to the VIX options really quickly here, Euan, because that is, of course, your bread and butter over there. We talk a lot here about how these options are trading, what the activity is going on out there, some of the interesting indicators of late. VIX as a product is always typically very call heavy. That's just the use case most people have for this product. They come in and they buy upside calls, whether to hedge or to spec. That's pretty much the primary use case. So VIX always going to be pretty heavy on the call side anyway. Tends to average around 2.6 to 1 or so calls to puts. Of late, we're seeing that starting to trend even higher. Some people tend to view the 3.0 level as some sort of indicator or benchmark. Of late, we're beyond that. We're actually in the 3.2 range when you're talking about total VIX options open interest right now. So I'm curious if you fall into that camp as well. Do you watch the open interest in VIX options, and do you think we're at some sort of interesting, perhaps, inflection point when it comes to the open interest?
Well, as a market maker, you always have to watch the open interest, because you know that, if the customers are definitely long something, you're going to have to sort of make your markets taking that into account. In terms of like a hard put-call ratio, we don't tend to do much directly along those lines. I think one of the reasons that the calls are getting bigger now is because, we basically have a structural low in the VIX of 9, and there's really only 3 strikes below here. So in a way, the calls have to be more, because the calls are probably listed all the way up to like 80 or 100. There are just a lot more strikes. There are a lot more calls you can trade. And the other thing is, there's no panic about the VIX going to 10. there's no real interest in that stuff. And the premium you get for selling those options really isn't worth it either. So I think some of this is just due to the highly asymmetric nature of the VIX and the fact we're kind of jammed a lot closer to one end than the other. Like we might go down 30%, but we could go up, 400 or 500%.
Yeah, that definitely, you're right. There could be a structural or a systemic issue at work there as well, which is making the calls just far more active right now, just from a dearth of options on the downside. It really is pretty much all calls at this point. Well, Euan, I'm very glad we can get you back on the show. I want to bring you on more often than whatever it's been, once every 3 years or so. But before we wrap up here, I know you're always working on interesting new stuff, probably some new books, some new research. So what are you working on right now? You want to give... And let me set that over. So what are you working on right now, and what are some hints you can give or some teases you can give our listeners for some stuff that you have coming down the pike?
Well, I'm always sort of writing how do you put it, relatively accessible articles. I write for Active Trader magazine, so I often write from the I find the academic papers that have most interested me over the last month or so and try to write a more accessible version of those, normally based around using options to trade from a retail perspective. From my own research, I'm working on the Kelly criterion quite a lot now. I've always been annoyed by people who dismiss the Kelly criterion on the basis that you need to understand the probabilities involved, the probability of you winning a trade and losing a trade, and they seem to think that this is a great mark against it. But I always point out that they're exactly what you need to do a trade in the first place. So if you can trade, if you think you have an edge, then you should also be able to figure out how big you should trade from the Kelly criterion. And so I'm working on the idea of trying to work out the actual level of uncertainty in the Kelly criterion given your uncertainty in the parameters. And so I've published a couple of papers on that in the last few months, and I'm still working along those lines. It's more gambling than trading, I think.
Yeah, it's kind of a stake management, if you will.
Yes.
But yeah, that's interesting. And any other books, any other lengthy tomes our listeners can look forward to coming down the pike?
Nothing I've really been inspired to do. Honestly, it's a lot easier to write papers than it is to write books. The amount of editing involved is just a lot less. It's not so much the writing that's painful, it's all the formatting and editing and stuff at the other end.
Well, Euan, I'm very glad we can get you on the program. And if the listeners want to learn more about what you're working on or some of the articles or books you've put out, of course, they can search for your name on Amazon for the books. That's Euan Sinclair, Sinclair, to find all those books and the articles, like you mentioned, on Active Trader and many other areas. Before you go, Euan, we like to end our show every week with our segment we call the Crystal Ball, which is us pontificating wildly, perhaps even recklessly, on what we see coming down the pike from a volatility perspective. I'll give you that same opportunity before you go. We'll extend the time frame for you a little bit because you probably won't be on for a little while again, but we'll extend it to the rest of the year. Let's talk broad strokes. What are you looking at from a volatility perspective for the rest of the year? Do you think we're going to be hovering around in this range again, perhaps with a few shocks, or do you think we're destined for another upside move in the VIX, or which way are you leaning right now?
Well, I'm just right now looking at the VIX chart, and it seems every 3 months we get a spike, but I don't really think that's predictive of anything. I think we're firmly stuck in the 12 to 15 range for the rest of the year. Leaving aside the possibility of some major macro event, a genuinely unforeseen event, I think the market has settled into this regime.
Well, Euan, like I said, very glad to get you back on the program. We'll have to bring you back on again more frequently than once every 2 to 3 years.
Okay, great. Thank you.
Great, thank you. All right, and that is going to do it for our Volatility Viewpoint segment. And now we're going to keep on rolling right on into our Volatility Voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility Voicemail. Make your voice heard by dialing 779-669-3663 4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, welcome to the Volatility voicemail segment. This is, of course, the portion of the program where we dive into some of your questions and comments and give you guys a little bit of time here on the old Volatility Views panel. All right, and first up on the old Volatility Viewpoint segment this week, we have a question from a listener who goes by the handle SoloHan. I like that. He writes, "Great show. Just discovered it, and I'm working through the back catalog as we speak. I just have one question so far, and I apologize if you've already covered this in the past. I'm an avid VXX trader." I think I know where this question is going. He goes on to write, "It's a core component of my portfolio, along with SPY and Facebook. I've heard Mark dismiss VXX in the past as only for very short-term trades, and if you buy and hold VXX, you will lose money. Can you explain this, please? What am I doing wrong by investing in VXX? Thanks again for this insightful program." Good question, Mr. SoloHan. We have covered this before, but because you have a fun handle, we'll give you give you another shot here on the show. This is a very common question. This is a popular use case for VXX with a lot of retail in particular, something that we just discussed with Euan a little bit as well in the Volatility Viewpoint segment. And unfortunately, it is the wrong use case for VXX. It was not designed as a buy and hold instrument. It was designed for very, very short-term, preferably intraday, if possible, type trades. And that reason for that is something we've discussed on this show many times in the past. It is the term structure of VIX futures. These product is rebalanced on a daily basis, so they have to essentially buy longer-term futures, which if you've seen the VIX term structure of late, and in general, those are typically much more expensive than the nearer term ones, and then they're selling nearer term futures against it to offset that. And so what you're doing is you're buying expensive volatility and you're selling cheap volatility, and that you can see in a long-term basis is not a long-term path to profitability. So intraday, for some quick in and out action, VXX could be a fine use case for that, or it could be a fine product for you. But if you're, as you're describing, buying and holding it alongside SPY as some sort of longer-term portfolio hedge, then you're really costing yourself a significant amount of money. I've seen a variety of studies on this, and they seem to estimate the cost of that roll, that negative roll yield, if you will, at somewhere between about 5 and I've even seen upwards of 14% a month. In terms of net cost to handle that roll and that rebalancing on a regular basis. So if you're buying and holding VXX, you are incurring that cost yourself. So intraday, go for it. Anything beyond that, I would be highly dubious of using VXX. Jared, what do you have to say here for our friend Mr. SoloHan?
Okay, I like the way you explained that about the VIX term structure. I would add to that, unless you're comfortable buying SPX puts in your account on a systematic, month after month basis and incurring those costs, then you're not going to find a much better result trading a long volatility product. But I think another issue that gets people sometimes isn't even so much the conceptual aspect, but the position sizing. I don't think there's anything wrong with having a systematic hedge in place, and that could be really useful, especially if you scale into it more and more as the market becomes more volatile or the market starts to change. But what you find a lot of the times is that people will buy way more shares of VXX than they would in terms of capital they're risking if they were trading, let's say, put options instead. And so I think that's something else to be aware of, even if you are going to trade these products.
All right, good stuff. Jared, we have time for one more here on the old Volatility voicemail. This one's coming from a listener who goes by the handle Sea Shanty. And he writes, "Can you please explain the difference between RVX options and IWM options? Aren't they both ways to trade Russell volatility? Love the show. Mark's a great host, and Jared brings that rural Virginia sensibility to volatility. Keep them coming." Well, Jared, he's going to be very disappointed when you move back to New York shortly. But to answer his question directly, I suppose in an indirect fashion, you are correct, Sea Shanty. They both are ways to trade volatility of the Russell, just like VIX and SPX or SPY options are both ways to trade the implied volatility of the S&P 500. But one is a pure form of that in the sense that the VIX is just a volatility product. It is just based off of the implied volatility of the S&P 500, or some may argue other factors way into that now. But an RVX is the same thing. It is just the implied volatility of the Russell 2000 versus IWM, which are the options on that Russell ETF. And so, of course, there is a volatility component to that. And as we just discussed with Euan, you could indeed harvest that by taking a lot of very transaction-heavy types approaches like delta neutral hedging and gamma scalping and all that fun stuff. But for the majority of listeners out there, that's not a practical road to hoe. So for the vast majority of you, if you actually do want just the implied vol of the Russell, then RVX is probably your best bet. Again, a pure volatility product versus a product that has a volatility component, as well as all the other things we talk about here on this show on a regular basis: interest rate, cost of carry, all that fun stuff, intrinsic value, all that fun stuff. It looks like the hinterlands of rural Virginia are not smiling on the Skype gods right now. So Jared won't get a chance to reply to our friend Mr. Sea Shanty, but I want to thank him and indeed all of you who wrote in. You have a lot of great questions coming into the show on a regular basis, so keep those coming. And I, of course, want to thank our guest, Mr. Euan Sinclair. If you want to find out more about him, again, search for his name, EUAN SINCLAIR, on Amazon to find his books or to find his research in Google. And, of course, surf on over to Bluefin Trading while you're at it and check out what those guys are up to over there. And on behalf of Jared and myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And, of course, for writing in with such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.